welcome to today's webcast brought to you by Regiment Securities and Capital Engine. Today we're talking about the $65 trillion shift where private market capital is moving next and continues to be moving. So we appreciate each and every one of you joining us today. And yes, this is being recorded. You'll get a copy of this afterwards. My name is Dean Delisle. I'm a partner and chief revenue officer at Regiment Securities. With us today, we have Brian Smith out of Cape Town, CEO at Capital Engine. And then we have Eric Cooper, the CRO for Capital Engine. And, what I'd like you to, hello, everybody. And what I'd like you to do is to kick it off. And keep in mind, you're in a browser-based broadcast system. So what that means is if anything technical happens, you just click the little reset button at the top. It looks like a half circle or a circle with an arrow. Just hit that and it'll refresh and you should get right back in if anything should happen. So I'm here broadcasting from Chicago. I want you to type in, where are you guys checking in from? So we like to hear where everyone is checking in from, because we'll ask you to type in things, or this is where you'll ask for question, or have questions along the way. So we have Houston, LA, we have New York, more Chicago, Scottsdale, Arizona, Lake Forest, Illinois, Oklahoma. Welcome, Andre. And the list goes on. We have some people in the UK. We have Boca Raton, and the list goes on. So you guys found it good, Fairfax, Virginia. So welcome, everybody. So let's, I always say, let's start. I want to plant a question. So how many of you feel like getting access to the best opportunities before they become obvious is available to you easily? So how many people feel that way? So you can type in, or you can just think about it as we get into this, because as we jump in and we start talking more about private markets, we're going to talk about the structural shift, why private markets are expanding rapidly, where capital is flowing, who's investing now, liquidity, innovation and tech, which is also interesting, how to evaluate private market opportunities, and implications for accredited investors. So let's jump right in. So Brian, I was rereading this morning and thinking about you, as we've had numerous conversations about this, but maybe give us your side, and then Eric will jump to you on sort of the transition that we've seen over the last period of time and what it's meant for you guys in the market.
Sure. Thanks, Dean. So, I feel it's an incredibly timely moment to be in private markets. We believe most of the value in today's markets is no longer created in public markets. We've seen over the past few months, we've seen clear signals from the likes of Morgan Stanley, Schwab, Goldman Sachs, all making major moves in private markets. And that kind of validates where the capital is heading, and also what Capital Engine has been building in terms of the private markets infrastructure. We're also seeing a fundamental shift. Companies are staying private a lot longer. There's more value creation, which is kind of happening prior to or before IPO. And then we're also seeing rapid expansion in terms of access, and that's driven by tech, new regulatory frameworks, in terms of tokenization, and then the growing participation of family offices, investment advisors, and high net worth investors.
Yeah. And then Eric, maybe from your lens?
Yeah, from my lens, from a perspective of where wealth creation has changed, it used to be that a lot of folks made money off IPOs and whatnot, and that clearly has changed quite a bit given the amount of public companies that there are now compared to just the amount that there were just a few years ago, and it seems like now only kind of special people get to participate in all these deals that generate alpha. So, it's kind of, it's an argument of if this is a real market or crony capitalism. So, that's one of the things we're setting, we've set out to do at Capital Engine, is democratize access to these really great deals that are out there for everybody.
Yeah, for sure. And you know what's interesting is I was at a conference in California last week, and there was about 1,000 investors there, and then Family Office Club prior to that. But one of the standing themes that's pretty interesting is that, you know, a lot of you know I started my career back in the 80s at Merrill Lynch. So now you know I'm pretty old. So with that, what I think has changed, I was just talking to a nice young lady yesterday. She's a pharmacist in LA. And she was like, I said, well, what's your interest in private markets? And she said, well, I've always trusted that you know, my brokerage would do the very best for me with my money, but I feel like now is a smart time for me to get educated and understand what private alternative investments are out there. So I think that's, you know, I think we're seeing more and more of that curiosity because there's more information. CNBC is talking about it every day. And, you know, I think people are just saying, okay, maybe it's time for me to understand what that looks like. So I think this is where the issuers and investors are meeting, you know, via the internet and platforms like Capital Engine to make sure we can service what it is they want. Now, I thought these numbers were pretty interesting, but Brian, did you do the research on this? I saw some of your notes in there, so I'll let you. I love numbers, so I'll let you kick this off.
Yeah, so I mean, I think if you can see from the slide that private market investment on pace to more than quadruple in size by 2032 to almost 65 trillion. And I think the primary driver of growth that we're seeing is the increased participation of individual high net worth retail investors in alternative investments. And this is kind of where we see the next big opportunity or the next big shift in financial services is the kind of rise of the retail investor and the impact it's going to have on private markets. Yeah, I mean, the estimates point to call it $14 trillion of new capital entering private markets over the next several years, and almost 7 trillion of that is coming from individual investors. Yeah, most of these are younger and newer to call it private market investing. So, yeah, I mean, I think, you know, fund managers and GPs that will kind of need to scale their operations and modernize their technology to kind of meet the expectations of some of these overwhelmingly digital native investors.
Yeah, Eric?
Yeah, and I absolutely agree with that. And I think one of the issues has been the lack of technology, as Brian mentioned, because, you know, I put my operator hat on a little bit. I was a CIO of a venture capital fund, and, you know, being able to offer your fund out to a retail investor is super tough, especially from an investor relations perspective. Sending out, being as transparent as possible, being able to send out information hasn't traditionally been easy. Now it's getting to be super easy.
Yeah, and I think there's a cross-pollination of platforms going on too. So, you know, as you see Robinhood and others make their attempt at private alternative investments, and then, you know, we've done some recent integrations with some of the big IRA groups out there in terms of people having a choice or an opportunity to say, well, I have a self-directed IRA. Self-directed means I can direct that too, not just count on my, you know, my financial advisor to tell me what categories based on my risk profile. But now I can take some of that money and put it into newer markets, and we're starting to see a trend of more and more of that money moving out of 401ks, IRAs to become more self-directed and self-managed. So it'll be interesting to see how that number hits. I didn't quite do the math, but I think I'll be old enough and my vision will be good in 2032. So I'm hoping I'll see most of that market. So I'm counting on it actually. So, you know, when you say companies stay private longer, you know, I was just watching this on, you know, so you think about timing with SpaceX going public and things like that. And then, you know, there's a report of, you know, IPOs were in high gear and now they slowed up. Of course, we had a wonderful government shutdown to deal with. But you're looking at, you know, the question that came up that I thought was interesting. It's like, is is SpaceX stealing all the IPO money, because it's so large and bringing so much attention. But what's happening is, I think also, Brian, to your point is, I mean, look at the numbers. 147,000. You want to dig into this
Yeah.
a little bit? Sure.
Yeah, so I mean, if you look at the data on the slide, I mean, I think it's pretty striking. It tells you everything about where the opportunity lies. I mean, there's 147,000 private companies globally with revenues of exceeding $100 million, compared to only 19,000 companies worldwide. So I think private markets, it's becoming the kind of the primary market for large companies. Why are companies staying private longer? I mean, I think there's been an abundant late stage private capital, companies like venture capital, like SoftBank, Tiger Global, and they're creating parallel financing systems that make public markets optional for growing companies. I mean, I think it's private companies face less regulatory burdens, so there's no quarterly earnings calls, no short seller pressure. And then I think founders also want to retain more strategic control.
Yeah, Eric.
Totally agree with that. And, I think a lot of it has to do with the regulatory burden that's been placed on companies and having to report on a quarterly basis and whatnot. That becomes quite onerous, especially, it used to be that, company at $100 to $500 million would typically go public. Now they're waiting longer because it costs so much money. It's just, and then having to report to the SEC and produce audited financials and everything like that. It just becomes burdensome.
Yeah, and what's interesting is well, go ahead.
No, I just wanted to add. So I think in our last webinar we talked about the Databricks. They're raising their Series L round, which is at $4 billion, and I think it was $134 billion valuation. And I think that kind of Series L isn't just about Databricks. It's about a broader shift. The private markets are becoming kind of the new public markets.
Yeah, and I was going to say, a lot of that we have the largest, as far as we can tell, distribution for IPOs to the retail market. So what's interesting is, we're part of that democratization that's given access to those IPOs. And so on our side, we're seeing, I think we have about 500 IPOs in the pipeline. Now, when they're going to go off, nobody knows. But it is interesting that they not delay it, but they seem to be prepping with private offerings too. So they, a lot of them are leading out with a Reg A so they can warm up the market and things like that. So we're seeing this mashup that we've never seen before of the democratizing of IPOs getting to the retail market and the retail market expanding more. And I think a lot of this 147,000 are companies that just have chose to raise capital. And like you said, it's more affordable, less complicated, and a way for them to do that. But we're seeing a trend moving with the retail market having more access to IPOs as well. So I think that's important to note.
And I'd also add too that, they also, the longer you stay private, the less time you have to focus on fundamentals. So, if you are a tech company and, you're producing product and that's kind of been your focus versus focusing on cash flow, then it probably makes sense to stay private a little bit longer.
Yeah, that's a good point. However, most everybody that tells me that does retail cap raise said, wow, we didn't realize this was a business that we'd have to get into as well. So they're treating, I don't want to say it's a mini IPO, but they're getting a taste of it. I always wonder sometimes when I look at the numbers, are they staying private because they don't want any more than they've had to go through with their private rounds, you know what I mean? Because now they have investor relations and they have departments and people they never had before just on raising capital. But so this is where capital is flowing. And it's interesting because I did a talk in LA last week about some of the hot sectors like sports and med tech and specific categories. But, Brian, do you want to speak to some of these and what you guys are seeing on where the capital's moving?
Yeah, so I mean, I think it's important because when you say private markets, we're not just talking about a single asset class. We're talking about probably an entire ecosystem.
Correct.
Private equity is still the largest segment. I mean, that's a scale play. Private credit is kind of where you've seen probably the most growth. I mean, we spoke about that last time, and that's driven by banks, pulling back and private capital stepping in. Infrastructure is kind of benefiting from long-term micro trends, energy transition, digital infrastructure, and capital's flowing in at kind of record levels. And then secondaries, and which is kind of critical to both private and public markets. That's becoming the liquidity layer of private markets is allowing investors to enter and exit position in ways that kind of didn't exist before.
Eric?
Yeah, I can completely agree. Some of this is a liquidity driven, but also a duration problem that some funds have had because companies are staying in those funds longer and they're not able to exit. So hence the birth of secondaries and how big it's gotten, which is pretty cool.
Right. And what's interesting is we have private credit up here and everybody's scratching their head like, wait a minute, isn't private credit having some troubles right now? But what I want to bring up around this is no matter what, each one of these segments have their benefits and their challenges, and there's always going to be market cycles, right? So a lot of times market cycles can dictate when real estate, real assets are good and bad, when private credit is good and bad. So that's why it's important to educate yourself on all these categories and match it against your risk profile to see what the appetite and tolerance is, for each and every one of you individually, right? And so I thought this was quite interesting. You're starting to see the rise of the wealth for the investor. Brian?
Yeah, I think it's, I think private markets have historically been dominated by, institutions, your pension funds, endowments, sovereign wealth funds. They're all allocating, kind of 20 to 40% of the portfolios for alternatives for over decades now. I think what's changed really is getting access. We're seeing a structural shift, kind of into the wealth channels. So the family offices are kind of leading the charge. I think there's kind of recent studies showed private markets make up roughly 30% of average family office portfolios, and probably 40% are increasing allocations in the next, call it 12 months. And then high net worth investor side, adoption is already widespread. I think over 90% of high net worth investors now allocate, to private and alternative investments. So I think it's important, it's definitely starting to flow through the advisors and wealth channels.
Yeah, which makes it really, really ripe for retail investors if you think about it, because I've done a lot of fundraising with family offices. At some point, when they get to a certain size, they look at growth from the perspective of asset liabilities, right? So they might not need a 20% rate of return. They might need an 8% rate of return to, if it's a $500 million portfolio, that's real money on an annual basis. So it's perfect timing for retail investors to enter the market for private from the perspective of private markets.
Yeah, that's excellent. And Sanford brings up a good question here, and we will have Q&A at the end. But, address private placement liquidity options for private investors. Should the expectations be a minimum hold for 1 to 3 years? And I think, Eric, you were alluding to this, but when we talk to our families and our high net worth, they're always willing to, to hedge that timeline to be more like 5 to 7 years and not 1 to 3. But on private placements and private investors, I'd say a reasonable tolerance is at 1 to 3 years if you can find it, but I think you're going to have a higher risk profile too, and you need to make sure you read all those risk disclosures and what they said. could possibly happen, why you won't get your liquidity in that time frame, because we're still seeing a lot of LP fatigue out there with private equity and VCs, depending on what the project is. So I think we're still up against some of that out there. What do you guys think about that?
It's also been decades of the whole private markets being set up to be on this 5-year rotating horizon, right? So we're just in the midst of a complete duration shift for how everyone looks at deals.
Yeah, and I always wonder when people get out, will they, will there be this whole flood of people that we'll see in our platform that we've never seen before, because they're finally free and they want to put their money somewhere, they're just not sure where. So go ahead, Brian. What do you have?
Yeah, so I mean, we've got I think 8 real estate funds that kind of use our technology, and kind of where we've seen where the investment is the funds that are kind of providing redemption. So I mean, most of them are obviously provide the kind of annual income, quarterly dividends, but where's key is like redemption. If the guys need to get their capital out, they normally put a 60, 90-day kind of clause into that, and it kind of works. We've seen it. I mean, the tech's kind of running that whole process for them.
I saw the private credit at 10 on this particular slide this morning, and I thought this was interesting. But with public equities at up there at the top, and then real assets, private credit, VC, and private equity. So Brian, you want to dig into this one a little bit, because I think the typical allocation guidelines was fascinating on this too. That was something I learned.
Well, I mean, I think at the core of this shift is one thing. It's returns. Private markets have consistently outperformed public markets over long periods, but in different ways depending on the kind of strategy. Private equity has historically delivered mid-teen returns, with top managers significantly outperforming that. That's been kind of the primary driver of institutional allocation for decades. I mean, venture capital can deliver even higher returns at the top end, but with much wider dispersion, and it's all about manager selection. It's kind of is key to the whole thing. Private credit is become especially attractive in today's environment. It offers kind of roughly 8 to 12% yields, with lower volatility. And I think that's why it's kind of had such a strong growth in the kind of past couple of years. And then if you compare that to public markets, I mean, that's delivered roughly 7 to 10% over time. The gap becomes clear. So I think it isn't just about high returns. I think it's more about access.
Yeah, and I think with when you see the 22 and the 20, and I think people get glossed over on that sometimes, and that's where they'll put their money. But remember, typically with that comes risk. I mean, your hold time in some cases, Eric, you and I were talking about this, where the hold time is supposed to be 5 to 7, and now it's 9 to 10 years, right?
Yeah, so then you tack on the investment horizon on front of that, and then you're retiring and when you're getting your returns back.
Right, exactly. So, I'm like, I'm 63. Do I really want 10-year returns? But I guess as long as I have the proper setup for my family to get, it's potentially.
Hey, you don't look 63, Dean.
You don't, Dean. Not at all.
All right. Yeah, it depends on how much moisture there is in the air. I might feel 63 or not. All right. So moving on, solving private markets' biggest challenge. Right. So, and we've been seeing a lot of the interval funds and the evergreen funds. So, Brian, you want to speak to this a little bit?
Yeah. I mean, I think, the biggest objection or historical objection to private markets has always been liquidity. We've spoken about that. Your typical lockup is 7 to 10 years. And that's kind of the price that you pay for, call it, the return premium. But I think that's changing, and it's it's starting to change quite quickly. We're seeing kind of innovation across three layers. First is like your evergreen and semi-liquid funds. Second, kind of at a market level, secondaries are now core part of the ecosystem. I mean, we're kind of building out that, secondaries, the kind of matching trading engines, linking up, part of our acquisition of our broker dealers to kind of become an ATS, alternative trading system. So that's, providing real liquidity through LP sales and continuation funds. And then third, I think kind of looking forward is like tokenization, the digitalization. I mean, it's still early, but it's kind of happening at a significant rate, fractional ownership, faster settlement, broader distribution.
Yeah, I'd almost combine real world assets and that tokenization too, because we're seeing a ton of that still in play.
We're still early inning. We're still early innings with all that stuff. That's the cool thing. I mean, there's huge opportunities. So, inning one, something like that?
Yeah, well then, and I'm invested in a interval fund, and it's the first one I invested in too. But it's interesting. I was listening to some of the wire news on certain interval funds, and how they were blended with private credit, and so now those interval funds, it's almost like there's a run on the bank, for people on that quarterly redemption period, and then it's like, okay, well, hopefully the manager has managed that where they have they have proper intervals to keep the fund healthy while it's intervaling. Saying even Sparky agrees with the entire entire thing on interval funds. He wants to make sure he gets his liquidity. But all good stuff.
I think we've touched on that. We built on the Reg A stuff. I mean, I think there's a real opportunity in the Reg A stuff. That's one of the only private exemptions that is not a restricted security. So kind of Reg D, 506B, 506C, Reg CF, they're all kind of restricted securities. You got to hold them for call it a minimum of 12 months. But kind of Reg A, allows you to raise up to $75 million per year. It's evergreen, and it's immediate tokenization. Immediate liquidity. You can connect that up with your transfer agent, and the beauty of that is kind of where we've seen the opportunities is obviously tokenization. The ability to tokenize some of these Reg A stuff. So it's interesting.
And it's the best prep for an issuer to feel what an IPO potentially could look like, or feel like, I should say.
Exactly. Yeah.
Let's see. And then, now we get into the tech of things, which we're all involved in tech, right? Tech and so, when we start to look at this, there's, there's platforms like Capital Engine, but what I really am keen in, because we both do this in our own way, but probably deal scoring is probably the best thing I've seen mature out of this. And it's funny because I was talking about the Regiment deal scoring system, and Brian's like, well, we have a Regiment deal scoring system. And then I'm like, well, maybe we should put our scoring systems together and see how things work together. But you want to speak to this, Brian, because you've been developing, Capital Engine for quite some time, but maybe just speak a little bit to some of the benefits that you've seen in terms of the tech platforms.
Yeah, I mean, I think what technology is kind of doing for private markets is kind of what it did for public markets in the 90s. It's dramatically lowering the barriers and expanding access. I mean, kind of what we built is really it's automating the entire investment journey or investor journey. It's the discovery, it's KYC, AML, accreditation, all the digitization of the subscription agreements, ongoing reporting, and including AI. I mean, you kind of start to, get AI to both analyze, on the call it the issuer side. I mean, we've added some AI tools where you could run AI on the issuer deal, and it can pick up if there's any issues on the offering documentation. And then kind of vice versa with the investing. The investors can use that really to kind of start balancing their portfolio or building a portfolio. So yeah, and I think AI. I mean, AI is a key thing to kind of where technology is going.
Yeah, like you were saying about the automated onboarding and things like that. I mean, these are things we just never had before. It's almost like the technology can pick up on the concierge part of, we used to have massive call centers to attend to people, both on the technical aspect of onboarding and conversion and transfer, where now a lot of times we can use a lot of AI and tech to help automate that and still allow the user to feel like someone is taking care of them, right? So we can have both that humanized aspect to it, and then with AI, it's just leaps and bounds. But Eric, you want to chime in on this?
Yeah, looking at these bullet points here, it's interesting because Capital Engine kind of provides each one of those on the platform, where our competitors will provide one or a couple of them. We do it all from a soup to nuts perspective, and the only way we can kind of overcome this private markets hurdle that we're trying to all jump over is with technology. So when you have a tool set, when you have this toolbox with all these tools that can help streamline all that, it makes it much better.
Yeah, and I always wondered, soup to nuts, does that mean the first course is soup and the last course is nuts? Just to ask.
Gosh, I hope not. That would be an awful palate cleanser, wouldn't it?
Not bad for fight.
Nuts is the dessert.
See, we cover all things on here, health and
Yes,
wellness.
we do.
Whatever it takes. So how do we evaluate? So this is an interesting question, because you heard me say that we both have scoring systems, and so we score based on, I think in common, we score on many of these things that you see. And what's interesting is when we would get a deal in, and Brian, you might have a different opinion of this, but I would always have one of my analysts tend to it, or more than one analyst tend to it. Now we would have a banker attend to it, and then you would have sort of the marketing person determine the marketability of the actual raise, right? So you'd have all these scoring factors, and it was so labor intensive and took so much time. And now with AI, we've been able to build in scoring and like we said, all the way from scoring to the deal to onboarding. But you want to jump in on some of this just from your side?
Yeah, sure. So, I mean, we kind of see 4 key areas. And yeah, I think, the scoring model itself, I mean, if you kind of add AI to that, I mean, it becomes a great analyzing tool. But first, market. I mean, is it a large growing opportunity with real structural tailwinds? Kind of second, business quality. And does the company have a kind of defensible differentiation and model that can scale? Kind of third is management, and that's probably the key, is the kind of jockey to the whole thing, and the most important factor. I mean, we look for teams with kind of proven execution, domain expertise, and then I think the fourth one, which is key, is exit visibility. You've got to have some sort of exit strategy defined.
Yeah, I agree with that. And then also, don't forget about our friends in compliance. I'm sure they're listening. So the fact that you can do all this and still have a pathway to get a compliance-based approval and a balance of marketability, conversion, and compliance, I think is something that is big time in there. But Eric, what about you?
I don't think I have much to add. I mean, you guys covered it. You can see how we evaluate it here. I guess I would add that, just the other day I was playing with an LBO model with some chat add-ins and some Anthropic add-ins, and it's a lot easier now to evaluate opportunities and do projections and stuff. So the tools are here to help out with this, and that's one of the things that retail investors will be able to utilize. They'll have all these. They now have all these tools at their disposal that the bulge brackets had. They just have to kind of look for them a little bit. So it's interesting.
Yeah. So, and to solve everybody's inquiring mind, one of my reps who's on that's also named Eric, and he thought I was talking to him when I was talking to you, Eric. So he was kind of trying to answer some questions really fast. But soup to nuts originated from the early 20th century formal multi-course dinners that began with soup and ended with nuts as dessert. So I had a good guess there. See,
Hopefully
we
it
can
was on top
solve
of a
any,
brownie
we can
or
answer
something.
any and all questions. All right, Sanford, we'll get to your question on Q&A, but but we're also solving, like I said, dietary restrictions and things like that. So understanding a private market risk. So we've been talking about risk the entire program, but now I think it's, maybe time to dig in. And again, this is the effectiveness of some of the scoring. So Brian, go ahead and kick this off.
Yeah, I mean, I think, some of the, from my kind of thinking, some of the pitfalls to potentially avoid, is underestimating the liquidity lock. Alternatives are typically illiquid. We know that. Failing to account for the kind of 7 to 10 year holding periods, kind of panic selling, maintaining kind of separate emergency funds, never kind of use rent money, debt for private equity or crypto. FOMO is always a good one, avoiding hot tips, from social media or influencers. And then ignoring fees, fees is a key thing in kind of private markets. They're typically hidden. Calculate the net of fee hurdle, ensure that manager incentives are aligned with kind of what your gains are. And then zero rebalancing, set a target for allocation, 5 to 10% of your portfolio, and stick to it.
Yeah, and remember, beauty is in the eye of the beholder. If it's a founder-driven valuation, it's probably a little higher than what it should be.
Yeah.
But with third-party valuations, or at least ask, how was the valuation sourced?
Yeah.
But Eric, your thoughts?
About valuation, yeah. I mean, it's always good to have a QOE or something with that, So, and these risks are very real when you're dealing with private markets. Of course, from a regulatory perspective, we see that as a low risk, and it is because we have that under control. So, but manager selection, absolutely. That's where you're going to get your returns. Illiquidity, yes. Long hold periods, yes. So.
Yeah, absolutely. Good stuff. All right, let's and again, type questions in. We're just about coming up on Q&A time here, folks. So, as we think about, what does this actually mean to the investors, and what should you do with all this, right? So, the first one is assess your allocation. You want to jump in on this, Brian?
Yeah. So, I think, as you said, what do we actually do with all this? I mean, we kind of think of it in 4 steps. First is, allocation. Institutions are already roughly allocating kind of call it 20% or more to private markets, while most wealth portfolios are still meaningfully under allocated. I think for many investors, the right starting point is a kind of diversified strategy. Private credit or secondaries, rather than kind of single deals. Obviously secondary liquidity. I mean, you have to align your allocations with kind of time horizon. If you're not comfortable, locking up your capital for 5 to 7 years, you've got to find opportunities that you can get access to your capital. Semi-liquid or evergreen structures. They offer kind of periodic liquidity. And then manager selection, I think, is key. It's critical, finding the right manager who can invest with you or invest in your behalf. And then I think the last one is kind of infrastructure. Private markets come with operational complexities, and that's kind of what we're building to in terms of the infrastructure. It's the onboarding, compliance, ongoing reporting, and then increasing access to kind of liquidity. So you need to find the right platform, with the right process that's scalable.
Yeah, absolutely. And Eric, whenever I look at liquidity timelines, we do a lot of these, and while, best laid plans, but, there's things that are within our control and things that aren't within our control, as issuers out there, people that have companies that are raising capital.
Yeah.
And all of us on the line have had some piece of that. And while we have the best intent to, let's say, exit in 3 years, we don't know what the market's going to be like in 3 years for anything, right? I mean, we can't predict that. So I always say, if you're going to tie up your capital in a private investment, it's whatever is stated +2. That's how I always looked at it. It's like, just in case, add that +2 cushion. So, and make sure you have better. Yeah, make sure you have beneficiaries too.
Yeah. And I think, number 3 is kind of echoing the other risk from the other page. How do we assess the focus on manager selection when in private markets, the managers don't necessarily, they're not transparent and they don't produce returns. We're at the dawn of being able to look, kind of peel back the layers of the onion with technology tools to see what the tendencies are and what possibly it might look like with all those future uncertainties that you mentioned, Dean. So, this is a good time.
Yeah, absolutely. And as we think about both companies that are here presenting to you today, and we're going to get to questions in just about a minute and a half. Capital Engine is the private markets infrastructure, right? And Regiment Securities is the investment bank. So as we work together, we have developed a good partnership and trust with Capital Engine. The fact that they do have AI-driven deal analytics and capital formation, investor onboarding and compliance. And what's nice is when we work with Capital Engine, we have something that we believe is a good change or an update to benefit the system. They're super responsive. So I think what's important is to know that you have a platform that already works. It's already proven. It has over 8,000 investors on it and a ton of opportunity in terms of private markets, but it's continuously innovating, so I think this is one of those things that you need to make sure, we've personally, myself and some of the folks on our team have worked with dozens of platforms. And the problem is they I don't know, they sort of set it and forget it in my mind. They don't put the benefits in that are changing with the way investors, invest and the way, the market moves. So I think that's one of the best things out there. So did I do a good job, Brian? Because that's my personal assessment. When I got to this slide, I said, I'm just going to talk about Capital Engines.
You did. Thanks, Dean. Yeah, I mean, if I can just add to that, our recent kind of strategic alliance with Regiment Securities, it kind of started, Regiment started out as a client, but I think, the alliance that we've kind of created, from a distribution, co-syndication and marketplace connectivity point of view. And, we can start to, with that infrastructure that we built, that call it broker-dealer solution, we can start to add additional broker-dealers and investment advisors to the network. And we kind of create this, call it daisy chain of deal flow and investors. And I think that's key. It's core to our end-to-end technology, the broker-dealer solution. So yeah, we're kind of looking forward to working with Regiment on this.
Yeah, absolutely.
Well, we can also provide a continuous improvement mindset to this, because this is evolving. So we're going to continue to evolve the tools as we need to. And the great, one of the things that Brian and I've talked about, and Gene, you and I have talked about this, is how this relationship that we have allows us all to punch above our weight class and go after some really intriguing deals. So
thanks for bringing my MMA background into this. I appreciate that. So some key takeaways, folks, and then we're going to jump into Q&A. So queue up those questions. Private markets are growing rapidly. We stated from 16 trillion today towards 65 trillion. So we'll see when we get to 2032, and I hope to be celebrating a percentage of the 65 trillion with each and every one of you at a conference that we hold together to celebrate this, but presenting the next decade of wealth creation, right? Wealth investors are entering the asset class, right? Family offices, RIAs. So we're not only seeing a convergence of retail investors busting through their IRAs, 401ks, but we're seeing family offices and high net worth folks coming into retail and requesting that us take their retail or their institutional investments and sharing with the retail market. So that's why you're seeing retail and IPOs. You're seeing different fund structures that allow retail to get into there. So I think this is a huge shift that's been coming, but it's here, and it's going to continue to come faster and faster with tech, and everything out there that's moving in the market. Liquidity solutions are expanding access. I mean, we didn't say this enough, but new structures like evergreen funds, tokenization are solving the illiquidity challenge. Technology platforms are transforming distribution, just like Capital Engine, and not just Capital Engine, but the integration that we're doing with Capital Engine and other platforms. So we have a platform at Regiment called Regiment Express. It's built on top of Capital Engine. We integrated it with Capital Engine, and now both of us are working together. We integrated that with other tech platforms where investors exist, like I mentioned, IRA platforms, et cetera. And then I think you're gonna, we have a commitment together on this team with Regiment and Capital Engine to continue to integrate tech together. So, as the list goes on. So let's jump into a little bit of Q&A. So with this, I'm going to get back to questions here. So let's see. So one is, how does Capital Engine increase its penetration into the private markets? Well, I think we're doing a little bit of that now, but I'll let you guys answer that at Capital Engine.
Yeah, so I mean, we've currently got around 25 to 30 clients that currently use our technology. So I mean, we're looking at expanding. You're doing strategic alliances. So Regiment, for example, with Regiment Securities is a kind of example of a strategic alliance that we we've built this broker-dealer solution. So it's regulatory compliance, and as I said, we're now looking to add other broker-dealers, investment advisors, kind of to this, call it daisy chain, of kind of broker-dealers, investment advisors, and that kind of creates this, call it this access to deal flow and investors, and the underlying technology is kind of what's key to really tracking, what's going on between the platforms. It's all with brokers. You've got registered reps, investment advisors. You've got obviously the advisors as well. We've got all that, call it key affiliate technology that tracks, when a registered rep sends out, kind of a deal, through email, we can track where that investor has come from. So it's key. So I mean, we focusing on the broker dealer solution, Reg A. We've seen as a key exemption to kind of, and then really where our core focus. We've got a lot of real estate funds that use our tech. We've got a couple of wealth managers. So and we've also started building out our own kind of proprietary platforms like USAREIT.com, which is our kind of commercial real estate strategy, 1031 exchanges, real estate funds, tokenization. So yeah.
Yeah, and if you guys want to book a meeting with the Capital Engine team, there's a pop-up on your screen right now, and you can just click on that, and you have access to the calendar. It'll match with your calendar and tell you what's available. So with that, we do have, like I said, we have recorded this, and we're going to continue to, as we finish up here, we're going to wrap this up, and then we're going to make sure that you get a copy of the recording with also contact information to all of us that are on today. One last question here. How should I think about making my first allocation into private markets? So Eric, you go first, 60 seconds or less.
Oh, geez. Go to capitalengine.io and you can start signing up and
then read everything on the pages. Yeah.
Yes, do that too from a compliance perspective, because we know we have to cover those bases too. But all jokes aside, yeah, just have a look. It would be awesome. So
Yeah, there's no cost, folks. You go on there and it's free for investors. So I say jump right in. Brian, would you say anything different?
No, I think, look at Regiment Express, Regiment's securities platform. There's a number of, really good private investment opportunities. And then the same with Capital Engine. We've got some, diversified, we've got a couple of real estate funds that are listed on there. They pay 10% annual, 2.5% quarterly, and with redemptions. So, I think there's investments for everyone, accredited investors.
And I think we have one that's listed on both. It's called OPUM. It's sports and medtech, and which is real hot right now. And that's, their ideal target, and they have a history of targeting at 3 to 4 years with 118% IRR. But again, read all the risk disclosures, read the PPMs, read all the materials, and make sure you make good decisions. And talk to us if you want to speak about any of the deals that you see on the website. So remember, the biggest risk right now isn't volatility. It's being on the outside of where value is being created, like in platforms just like this. If you want access, better deal flow, or want to understand how this fits, just go in. We're really big about education, and we want to make sure that you guys have that access as well. So our goal is not just, as you know, we're doing things on the IPO side, but we've always been part of private markets because that's what gives birth to the IPOs. So we want you guys to continue to learn, continue to be curious, continue to ask questions, and we're here as a resource for you along the way. So we want to thank you for your time today and really appreciate each and every one of you. And we'll see you on the next one, okay?
thanks, everybody.
Take care, everybody.
Thanks, everybody. Dean, thanks for putting it together.
You got it. We'll see you
See you
all
soon.
real soon on the meeting. Thanks, folks.
Thanks, Eric.
Thank you.